This video is for educational purposes only. It is not financial, tax, or legal advice. Always do your own research and follow the laws and reporting rules of your country. If you're a European citizen and all your money depends on one country, one banking system, and one currency, you're exposed to a risk most people don't even think about. Today, I'll explain why Switzerland is used by Europeans across the continent. Not for secrecy, not for hype, not for tax evasion or shady stuff, but for one main reason. But first, let's add a bit of context. Did you know Switzerland, a country smaller than West Virginia, has been independent since 1291? That's over 700 years. What's even more incredible is how it manages its diversity. Switzerland has 4 official languages: German, French, Italian, and Romansh. You might think everyone is multilingual, but that's not always the case. Someone from the German-speaking part might not speak French, and vice versa. It's truly amazing to see a country with 4 distinct linguistic and cultural regions run so smoothly and peacefully. Meanwhile, you have nations with just one language that can't seem to get along. Switzerland is a real-life example of unity in diversity. And stay until the end, because I'll give you a simple checklist to see if Swiss banking actually makes sense for you, and when it does not. Let's make this very clear from the start. The main reason people use the Swiss banking system is stability, not higher returns, not speculation, not getting rich fast. Swiss banking is used as a financial anchor, a place to reduce risk and protect value over time. Switzerland offers political stability, strong institutions, and predictable rules. That predictability is extremely valuable when the world becomes uncertain. In finance, stability often beats performance. You don't just want your money to grow, you want it to survive. This is about building a solid foundation that can withstand economic shocks, political changes, or unexpected crises. The Swiss system is built on a long history of neutrality and careful management, which gives savers and investors a sense of security that is hard to find elsewhere. Many people focus on returns, but experienced investors focus on risk first. A system can offer high returns and still be fragile. Swiss banking is designed to survive crises, not chase trends. That's why large institutions, wealthy families, and international businesses rely on it. Think about it this way. You don't need maximum growth. You need durability. High growth investments can be exciting, but they often come with high volatility. If your entire financial life is tied to a single, potentially volatile system, you're taking a big gamble. Swiss banking acts as a counterbalance. It's the part of your portfolio that isn't trying to hit a home run. It's just trying to stay in the game, no matter how rough it gets. This conservative approach is what makes it so attractive to those who prioritize capital preservation. It is about ensuring that a portion of your wealth is protected from the ups and downs of more speculative markets. Stability also shows up in the currency. The Swiss franc, or CHF, is widely considered a defensive currency. Ever wondered why everyone's talking about the Swiss franc? Let's take a quick trip around the world of currencies. The Swiss franc, or CHF, is famous for being incredibly stable, like a rock in a stormy sea. So how does it stack up against the big players? Right now, 1 Swiss franc is worth just over €1. Pretty close, right? Remember that Switzerland is home to about 8 million people, and EU has a population of approximately 450 million people. The comparison makes even more sense when you look at the US dollar. 1 CHF gets you about $1.25. So it's even stronger than the world's biggest economy, the USA. What does this all mean? The Swiss franc is a powerhouse, often seen as a safe haven for money when things get shaky elsewhere. It's a small country with a mighty currency. Imagine a country of roughly 42,000 square km. Having a currency as strong as the United States or the whole of the EU, they must be doing something right, right? When global uncertainty rises, many currencies lose value. The Swiss franc often holds its value or even strengthens. Here's a concrete example, using the Indian rupee. On March 26, 2021, 1 Swiss franc was about 77 Indian rupees. That means 1,000 Swiss francs was worth around 77,000 rupees. By January 2026, 1 Swiss franc had strengthened to about 112 rupees. The same 1,000 francs now gives you roughly 112,000 rupees. That's about 35,000 extra rupees without doing anything. In many parts of India, that difference alone can equal an extra monthly salary. Now, it's important to clarify, this is not a guarantee or a promise. It's an illustration of why the Swiss franc is often used as a store of value. Currency diversification isn't speculation. It's a strategic move to hedge against the devaluation of your home currency. Holding assets in a strong, stable currency like the CHF can protect your purchasing power over the long term. Most Europeans keep everything in one system: salary, savings, investments, credit, all under one jurisdiction. This always sounded crazy to me, especially since you have concrete examples of currencies being completely devaluated in an instant. One of the best and most recent examples I've found is the Iranian rial, the official currency of Iran. On January 2nd, 2026, about 2 weeks before I'm recording this video, 1 Swiss franc was worth roughly 52,000 Iranian rials. Fast forward just 2 weeks, and likely influenced by US actions affecting Venezuela and its oil market, 1 CHF now buys 1.3 million rials. That's a staggering 2,454% increase in an incredibly short amount of time. This means the Iranian currency has lost significant, if not all value relative to the Swiss franc. For people in Iran, salaries may remain numerically similar, but prices rise sharply, reducing real purchasing power. That's how inflation and currency depreciation affect everyday life. On the other hand, someone holding Swiss francs hasn't done anything differently. Yet their purchasing power in Iran has increased simply because their currency retained its value. The difference isn't effort, it's currency strength. Swiss banking adds a second legal and regulatory environment, different regulators, a different legal framework. This means less single system dependency. This is not about abandoning your country. It's about not putting all your eggs in one basket. Resilience comes from separation. When all your assets are governed by the same set of laws and the same central bank, any change in that country's policy, whether it's new taxes, capital controls, or an economic downturn, affects everything you own. By placing some assets in Switzerland, you create a firebreak. A problem in your home country's banking system won't necessarily impact your Swiss assets, and vice versa. This principle of jurisdiction diversification is a cornerstone of sophisticated wealth management for anyone operating internationally. Switzerland is also economically competitive. The standard value-added tax, or VAT, is only 8.1%. That's significantly lower than in most European countries, which makes it an attractive place for business. Taxes can vary by canton, which are like states or provinces. For example, the canton of Zug is known for its very low corporate and personal taxes, making it a hub for international companies. Canton Schweiz is also highly tax efficient. Canton Zurich has higher taxes, but it remains competitive on an international scale due to its global financial infrastructure. This doesn't mean there are no taxes. It means you have predictability, efficiency, and choice when everything is structured legally and in full compliance with international reporting standards. The Swiss tax system is designed to be stable and business-friendly, which contributes to the overall strength of its economy. The quality of life in a country often reflects the quality of its systems. Switzerland consistently ranks among the top 3 countries globally for quality of life. It has safe cities, excellent infrastructure, a clean environment, strong healthcare, and high purchasing power. Strong societies protect value. A country that can maintain such a high standard of living usually has robust, well-managed institutions. These are the same institutions that oversee the banking sector. When you see a society that functions this well, it gives you confidence that its financial system is built on a similar foundation of competence and reliability. This connection between a country's overall health and its financial stability is a key reason why people trust Switzerland with their assets. They are not just buying into a bank, they are buying into a well-run system. If this video is useful, subscribe and activate the bell. It's free and it helps support the channel. So how does this work in practice? European citizens can open bank accounts in Switzerland. The typical steps include choosing the right bank for your needs, providing your identification and proof of address, and clearly explaining the source of your funds. You will also need to declare your tax residency to ensure compliance with international reporting agreements like the automatic exchange of information. You have to pass strict compliance checks. Swiss banks are famously strict with their onboarding process, and that's exactly why they're trusted. A system that is easy to get into is often a weak system. The thorough vetting process ensures that the bank is dealing with legitimate clients and clean money, which protects the integrity of the entire system. EU citizens can also open companies in Switzerland with the right legal structure. The system is business friendly, but the rules must always be respected. Strict onboarding equals a strong system. Now for that final checklist, ask yourself these questions. Do I want more stability in my financial life? Do I want exposure to the Swiss franc as a defensive currency? Do I want to diversify across a second jurisdiction? Do I value predictable rules and a stable legal framework? And finally, can I handle the stricter onboarding process and potentially higher fees? If you answered yes to 2 or more of these questions, Swiss banking may be something worth exploring further for your own situation. If this video helped you, leave a like and subscribe. And let's start a debate in the comments. Is relying on a single banking system still reasonable in 2026? Thanks for watching.